Good morning or good afternoon, everybody. Welcome to today's webinar, Introducing Boost, help your clients gain a competitive advantage with a bridge loan in a hot housing market. Now, we want this to be as interactive and as engaging as possible. So during the webinar, if you guys have any questions, just go ahead and use the little chat tool, and I will ask the speakers on your behalf. So with that, I'm going to introduce today's speakers. Take it away, Mark.
Hey, good morning and good afternoon for whatever part of the country you're in. My name is Mark Lutzy. I'm the regional manager. I'm out of San Diego, California normally, but today I'm in Frisco, Texas. So thanks for the great weather here in Texas today. With me, I also have Rick Harway out of California, account executive with us, and Steve Arledge runs credit for us on the Western United States. So we're happy to have these gentlemen present with me. And let's talk to you a little bit about today's product. We're really excited to kind of get engaged with the rebranding of a program that we have used now for about a year, and we were calling it a bridge loan for a period of time, and it became very confusing. Let me see here if I can switch my screen. Rose, there we go. So today's agenda, we're going to tell you a little bit about us, what we do. We're going to introduce the Boost loan for you. We're going to teach you a little bit how about it works. We're going to walk you through some key talking points. Rose is going to follow it up with showing you guys how to market the product from a loan officer level, and then we'll handle some Q&A, and we have our subject matter expert here, Mr. Arledge. So let's get going. A little bit of a delay on our slide here.
You might be able to use the up and down arrows, Mark, as well.
Okay.
Here, I'll go ahead and advance it for you.
Yeah, that'd be great. Okay, so what we do, we're traditionally a non-QM lender. We do not have any FHA, Fannie Mae type products. A little bit of a rundown. We determine ATR differently than agency loans, so we have multiple different ways of expanding income qualifications. So we do bank statement loans. We do asset depletion loans. We can do a combination of both. We have an interest-only feature for DSCR. We can use your DSCR ratio, or payment for your DSCR ratio. We can handle properties from 1 to 4 units. We also do 5 to 8 units. Warrantable, non-warrantable condos, condotels are just some examples.
I'm going to go back one just because I'm so happy that it's all green now.
Sure.
No more gray ones.
Great, thanks, Rose. So we're about 9 years strong and one of the first in the non-QM sector. And we just basically gotten our 49th state approved. The only one you can see that still needs some help is New York, where we can do non-owner occupied properties only. But other than that, we have a full footprint for you to lend in. So wherever you're attending from today, we're going to be able to help you out. We've been securitizing loans for the last 7 years. And we got a highly experienced management team in almost all of the states. Go ahead, Rose.
Mm-hmm.
So we are a bridge loan lender that has non-QM products too. And essentially, that's kind of our sales mantra today, because we wanted to get the word out that we definitely do bridge loans. So we're a full service non-QM lender. We can associate all this with bank statement loans, DSCR loans, but our bridge loan product is extremely beneficial for you today's market. Go ahead and pass through here. We're calling it Boost. Boost stands for Bridge Option Offering Seamless Transitions. And the reason we're calling it Boost is the hardship that we had last year, basically differentiating our bridge loan program for traditional bridge loans. So fix and flip use the term, hard money uses the term. There's several different types of bridge loans out there. Ours is different, and I'm going to show you why. We've labeled it Boost. The difference between Boost and other programs out there is we handle both loans. We actually write a bridge loan to access the equity on the departing property, and we utilize that equity as a down payment, and we can utilize that equity for other sources to get the loan qualified, either DTI. You can use the equity for carpet and paint on the departing property. We'll get into all those features and benefits, but that's the structure of the loan. We close both loans within a 10-day period of time. If we're going to teach you anything about this program, it's going to be these three main objectives. We handle DTI issues. When we first rolled this program out, we rolled it out intending that we're a bank statement lender, that most of the loans we're going to see are bank statement loans. It's actually the opposite. Most of the loans that we're finding that we're funding today are Fannie Mae type qualified borrowers. These borrowers are running into DTI issues, and the problems start with not just the increase in interest rates, but also the consumer debt at all-time high levels. So when you compound the departing property payment, high interest rate, high consumer levels, and then ultimately your proposed payment, your DTIs just aren't working for a particular transaction. And that's where the Boost program comes into play. We actually have no monthly payments on the departing property, and we have no monthly payments for 12 months. So you have a full year to sell your property. It removes the clock. We're going to get into all the benefits of that here in a second, but that's the second main point. So DTI, no monthly payments for a year. And then lastly, what that makes is your borrower to be a non-contingent buyer. And you know the difference between throwing contingencies out there and who's getting approved or accepted by the sellers. It's going to be your non-contingent offer. That's without a doubt one of the major benefits of the program. We can make your borrower non-contingent in less than 48 hours with the appropriate documentation, and your account executives can help you do that. Go ahead, Rose. So why Boost? So if you look at the national average of loan to value, how the country is leveraged with owner-occupied property, you're sitting at roughly a 49% LTV. We're equity rich. And the reason that's the case is 14 years of solid appreciation. So people are interested in entering the market today, but one of the restrictions that they're having, or one of the ways that they're not satisfying the transaction that they want to get into, is not being able to utilize their equity immediately. So they're, depending on where you are, you're trying to leverage, can I buy before I sell? And that's what Boost allows you to do. So even with today's high interest rates, the real estate market's very strong overall. There's definitely some very good feedback about its tenacity, even with high interest rates, and increase your borrower's negotiating power. So why settle for a fire sale when you can actually utilize Boost and actually get full price for your departing property, and also be a non-contingent buyer, be taken serious on the purchasing side. So unlock the tools to make your buyer more competitive and get their offer accepted. Go ahead. So Rick, I'm going to go ahead and get you involved here. Why don't you help us out with today's housing market?
Yeah, thanks, Mark. I appreciate that. So some of the biggest benefits of utilizing Boost that we've found in rolling this program out to all of our clients is that it gives buyers the flexibility to be able to get the best price possible on their home. Especially if it's a primary residence, they have up to 12 months to be able to sell the home with no monthly payments required. And if it's a non-owner occupied property, they have up to 6 months to be able to sell it. So still being able to test the waters and going to the high end of the market to be able to maximize their profits. And then again, on the purchase side of the transaction, you're able to move quickly. You can shorten escrows and be a more aggressive buyer in the market, not having to be limited with a contingent offer. And then sellers will be more motivated to offer concessions. Again, you can enter into negotiations in a much stronger position with cash-like offer, non-contingency, et cetera. So it gives you a much more authority to be able to lean in to a new purchase transaction while not feeling that you're having to compromise on the back end of the transaction and selling the home that you're leaving behind. And then getting the highest prices possible on the departure property. Again, that 12-month balloon for owner-occupied properties and 6 months for non-owner really gives you a ton of time to be able to work the market to your benefit. And at the end of the transaction too, we've had happen a few times where borrowers have gone the distance and either that 12 or 6 month cycle and not been able to successfully sell the home for one reason or another. And we've approached the borrower and looked at flipping that bridge loan into a longer term solution too. So you don't necessarily have to be concerned about, well, what happens if the balloon expires? What happens to my clients then? We have solutions there for you as well. And ultimately, it just allows you to be able to avoid the fire sale type of selling the home below market, and again, being able to leave profits on the table. You can go to the next one, Rose.
Before we continue, I did get a comment from somebody, and I don't know if we're going to answer this, but if you can hear me, if your sound is working properly, could you please just comment yes or something? I just got a comment. Thank you so much, you guys. I really appreciate it. I'm sorry, Rick, please go on.
No, thank you. All right, so as far as the Boost program and how the nuts and bolts of it work, there's no monthly payment required on the bridge loan. So we'll make the loan at accrues interest on a per diem basis, just like any other loan, but that interest is collected when the home sells and the mortgage lien is paid off with the interest, et cetera. And then the remaining equity would then obviously go to the borrower to be able to use for whatever they want to do that for. But it gives the borrower cash out. Go ahead.
Rick, I wanted to just chime in there about,
Please.
I can't say enough about the flexibility of this product. Can you hear me all right?
Yeah.
Your sound
Okay.
is, yeah, it's okay.
I just wanted to give you an example of one I looked at this morning. It was a retired couple. They were on Social Security income. They had some note income coming in, but they couldn't quite qualify for the new purchase with their current income situation. So what we did was we're doing a $950,000 purchase at 60 LTV. We're using our bridge product. They have $1 million current primary residence that they own free and clear. We're doing a 75 LTV bridge. We're giving them the money for their down payment. We're giving them additional money, an additional $350,000. I take that back. $350,000 to go along with the assets they currently had, which was $290,000. We're taking that $600 and something thousand in asset, doing asset depletion on it. So now we got their note income, their Social Security income, and the asset depletion income, thanks to some of the proceeds from the bridge loan that we're doing that has no payments on it, so that they can use that for income to qualify and stay at 43% debt ratio with a 711 FICO. I mean, they're great borrowers. They'll get the additional 25% when their property sells, so they'll have more than enough to service that debt and pay it down if they'd like to. But that's what I'm trying to emphasize is the amount of flexibility this product gives you, the tools it puts in your quill. In other words, you can pay off debt with it. You can improve the home you're getting ready to sell so that you get more for that property, that the retained property that we're doing the bridge on, than you might have otherwise gotten. Do some sprucing up to it. You can do some sprucing up to the property you're moving into. There's so much flexibility that this adds to.
Hey, you stole my thunder, Steve. Does that mean I can call that approval out on my loan to my broker then?
You put it out.
That's fantastic. But I mean, that's a great summary right there of all the different things that we can accomplish with this product. And it's been super impactful. I will acknowledge a year ago today, probably 10 to 15% of my pipeline was of the bridge loan variety. And now that we've overhauled the marketing campaign and really been out promoting it, today I'm happy to say it's approaching close to 60% of my pipeline and growing. Just before I got on this call, I had 3 additional calls following a roadshow that we did last week, or excuse me, 2 weeks ago, in the Phoenix market, out there promoting this program. It's just people can't seem to get enough of it. It's amazing. Once they get on board with even entertaining it, they realize how fast they can move. While, as Steve touched on, whether it's maximizing the profit and using some of the proceeds of being able to spruce up the home that they're selling, or maybe it's sprucing up the new home. There's some things that they want to do there, right? There's so many different variables that you can do that you really need to be reaching out to your local account executive to say, hey, I've got someone, I think we can go through this. We can walk through the numbers in a matter of a few minutes and see if it's something that would make sense and fit the product parameters, or if it doesn't. And if it doesn't, then you can pivot and go in a different direction.
Hey, Steve, Stephanie wants to know, is there an escrow account required on the departure loan?
We pay the taxes for the year. So at closing, we pay the property taxes for the year. The only thing the borrower would have to pay, there's no escrow account set up, we just pay the taxes. But if the borrower has an HOA, we'd have to include that in the budget. But otherwise, you're being hit with no payment for the thing, for taxes, for the principal, nothing.
And Eric wants to know, is there a loan limit on this bridge loan?
Yes, our minimum loan amount is $250,000. Our maximum loan amount is $2 million. We have made exceptions on both sides of that spectrum. We're pretty much an exception lender. So if we like the deal, we're going to do it. but those are what the guidelines would indicate.
Awesome. And Rick, Philip wants to know, does the borrower need to do the end financing with LendSure?
Yeah, we do need to do the purchase loan as well. Candidly, the bridge loan is a loss leader for us. We really don't make any money on the bridge loan at all. But it gives us the opportunity to be able to help the borrower access that equity and then also be able to assist with the purchase transaction. But that is a requirement. We need to tackle both loans.
I'm just going to add there that what I see a lot of, I see these all the time. I mean, all I do generally is approve loans, and all the bridge loans come up to senior management. I get the luxury of getting to look at every bridge loan we do in the Western U.S. And the fact of the matter is, I see so many of these borrowers that are conforming borrowers that are, a lot of them are maybe retiring, like the last one I talked about, where they're moving down. They've got this big, huge amount of equity on that property out there that, they live in California. Maybe they're buying in Arizona to retire, and they're moving down. But because of the fact that we're doing this bridge loan, maybe they take a 60 LTV on the refinance, and we're looking at 50, sometimes less, 40, 35 LTV on the purchase, so that it's so low that our rates are pretty competitive anyway. But we get an awful lot of conforming full doc 740 FICO borrowers choosing to go this route.
Yep.
Okay. And Roger wants to know, does the 12 months of interest payments included in the 75 LTV?
No, so it would be on top of that.
Okay, great.
You could probably click to the next slide. Yeah, perfect, Rose. Thank you. You're reading my mind. So really two key things that make our bridge loan unique. First and foremost, we don't have a monthly payment that's calculated into your debt to income ratio. So when out purchasing, especially helpful when someone's buying up, maybe it's a younger family and they need a larger home, or they're relocating somewhere, what have you, not including that in the debt to income ratio is a game changer. And that's really the secret sauce, if you will. And then most other lenders out there in the market that have some sort of a bridge loan option available, they do calculate that in, and you have to be able to juggle 2 mortgage payments at the same time and get your borrower to be able to qualify, which is really, really difficult. So having that no payment feature is just, again, I use it as a secret sauce, the silver bullet, whatever you want to call it, but that's really the key piece. Mark, I'll turn it back to you.
Oh, minimize transition hassles. This is another benefit of the bridge, of their boost loan. So you don't have to worry about temporary housing. We've seen that stressful situation in a number of loan closings in today's market. When you're dealing with back-to-back escrows and one not performing, provides buyer time to make improvements such as paint, flooring, and before moving in. So I've seen this work on both the purchase and the sale. So people are buying some fixer-uppers and they want to have the property adjusted before they move in. They want a new kitchen. They want their bedrooms or bathrooms redone. And having a no payment situation on the departing property allows them a little flexibility to be able to do that. Put 60 days worth of contractor work. Same thing with the departing property. They've lived in it for 15 years. They wanted to appropriately sell it. Now that there's not a fire sale situation, they can actually put carpet and paint, spend 30 days in getting the property spruced up to get the highest price in the market. And not just to mention the sellers are appreciative of that, but the real estate agents are as well. Go ahead, Rose.
Sure. Cynthia has a question. This is an interesting one. I'm assuming this refers to maybe property investors. What if the seller has 2 departure properties that go into one?
So that's a good question. We've done a number of these recently where not only are they removing or departing from their owner-occupied property, but they're selling off their non-owner properties as well. And they're taking all of that equity and utilizing that in the boost format to purchase a new buy up. And so Steve maybe can give even another example, but I know that we've done a couple of these where there's multiple transactions.
I've done several of them, where they're either leaving owner occupied and a non-owner, or an owner occupied and a second home to buy a new primary. And we have no problem with that. The LTVs on the non-owners are not as high as the primaries, obviously. So there's an adjustment for LTV, but if they have equity in a non-owner and we can tap it, we can do that.
Okay.
So I do want to add one caveat, Rose, before you ask another question, that if we do have any Texas loan officers on the call, I just want to make sure that we're on the same page right away. I should have mentioned this earlier. The Homestead Act prevents this program from being successful going from Texas property to Texas property if they're both owner occupied. If it's perfect though for relocations. So people that are moving from the other 49 states, i.e. California, to Texas, this program is fantastic for Texas loan officers. But I just wanted to make sure that you guys knew that.
Okay.
Did you have another question?
Yeah, Brian has a question. So do you have a guarantee purchase component to this after 12 months or up if they cannot sell? Otherwise, Fannie won't allow it to be non-contingent.
Yeah, so we do not have what you would call a guarantee, but our exit strategy on a property that's coming due for a full 12-month term, meaning by month 10, we're probably going to call you as the originator up and ask you, would you be interested in talking to your loan officer or to your borrower about a DSCR exchange? Let's move them into renters as opposed to a departing property situation, and we'd refinance them with you into a DSCR property.
Okay.
And as we've said, I think we've repeatedly said the market is pretty hot. We're not anticipating a whole lot of these properties being on the market for 12 months without selling. If you're priced right, that shouldn't be the case in most markets.
Yeah, and Cynthia wants to know, what's the prepayment penalty if they choose to refi after the departure sells?
Neither loans actually have prepayment penalties. So let's be clear. The bridge loan is intended to pay off as soon as possible. And then the new financing is based on your broker contract with LendSure's. So whatever it is that you guys have signed in regards to an early payoff or an EPO, that would be your determining factor on how you want to schedule financing with this program. So a lot of our loan officers do use the program. They go full term on their EPO, and then they're ultimately refinancing the borrower off of LendSure's loan and into their own product, more Fannie Mae driven. That's completely allowable. Neither products have prepayment penalties.
I've got several questions asking about the rates. What do the rates look like on the Boost program?
Well, we're going to get that in probably the next slide, so I won't answer that just yet, but let's cover this real quickly. So the things that Rick, Steve, and I are seeing on a daily basis of what people are using their equity for besides just the down payment. Like I said, folks are equity rich right now, so they're covering all of their closing costs. I'm about to show you a loan scenario where there wasn't a single nickel out of pocket for them to get into their new home. People sometimes may need to pay off debt to qualify, going full doc, satisfy ATR. And like I had mentioned earlier, consumer debt's at an all-time high. So this is definitely a leveraging point for people to ratio. Covering moving expenses. We all know that that's a terrible expense, and they can ultimately utilize their cash out and their equity to do so. Furnish their new home. People are buying new furniture for their new home. We've heard that. Home improvements on the new home. I've already mentioned that. And then also renovating their departing property. Mentioned that as well. So all good uses for their equity and a positive transition for your borrower. Go ahead.
Okay, great. And then Gregory, yes, I do have marketing resources for you guys, and I'm going to be sending that off to you after the webinar. Look for an email from me, Rose Malty, about an hour after the webinar, and that's going to include not only the slide deck and the recording of this webinar, but it's also going to include a link to our private legal resource kit with flyers and email templates and even a video that you can use for your borrowers and your realtors. Speaking of realtors.
So advantages to real estate agents. So one of the things that I've learned about presenting this product over the last 12 months is there is a pipeline of cold leads with all of the real estate agents that you work with. These are unsuccessful transactions. These buyers stop the process for interest rates. They submitted 3 or 4 offers and none of them got entertained. It becomes defeating. They get emotionally attached to these properties, and not even to hear back from the seller, it just gives them the reasons to pass over the opportunity of buying up. So this product really does have the ability for your agents to re-engage these conversations and turn these cold leads into warm leads. And if you're able to work with your realtors, my account executives nationally would be happy to jump on a webinar with your real estate agents show them the product, give them the features and benefits, educate them on how to start that conversation again. And it's amazing just by doing so what materializes into an active pipeline. Go
Yeah,
ahead,
Mark,
Rose.
I can speak to that a little bit. As you know, I actually have 2 of those presentations set up next week following that roadshow I mentioned earlier, with a couple of my clients out in the Phoenix market, and the realtor interest it blew me away. I think one of them right now, we already have 50 people signed up to be a participant in that. And the second one is in early March, and the early numbers are coming in are equally impressive. So we're excited to be able to get on and talk to realtors and educate them about how this program works, because it's a win-win for everybody.
And in fact, one of the things that you are going to get in the marketing thing is a slide deck that you can customize with your logo, your contact info, that you can present this program in simpler terms to your realtor and your realtors and your referral sources.
So we get a lot of different, qualification questions. So in regards to occupancy and eligibility, we pretty much handle the spectrum. Primary residences is really the driver for the product, but we've been involved with second homes. We also do investment properties, non-owners to non-owners. We can incorporate that with your 1031 exchanges. We can incorporate that with your reverse 1031s, and we can even do a reverse 1031 bridge loan, believe it or not. Whole different presentation. Property types, SFRs, condos, PUDs, townhomes, we're working with all of them. So give us a shot.
If you guys are less interested in learning more about the 1031 exchange specifically and how that works, you can go to LendSure.com, click on resources, and you'll see our recorded webinars. We did one in December, I think, on 1031s and incorporating that with the bridge loan program.
And when we said no prepayment penalties on the purchase property, that was on primary residences. The non-owners would have one.
Thank you, Steve. That's a great point. So here's some nitty gritty for you guys. We had been asked earlier, what are your interest rates? Well, it is a fixed rate, 899 for a 12-month balloon. That's right, 899. It's if you compare this to any bridge loan in America today, we're not even close to the rates that are being offered out there. 899 is incredibly low. No monthly payments for a year. You can see your interest only option widget out there that people do ask, can we recast and pay down the new financing and recast that payment? The answer is yes, we do allow that. As long as you use your interest only feature, then the payment would recast as well. We can go up to 75 LTV. Again, we handle both loans. Common question. The reason we're handling both loans is that it's one transaction when you really boil it down. You're going to handle the departing property bridge and the purchase all with essentially LendSure and possibly even one escrow company. We do charge 2 points on the bridge property. You want to know that, and that's taken out of their equity. And then the DTI on the new purchase is up to 50 LTV, or I'm sorry, 50 DTI on the back end. Go ahead, Rose.
Okay.
So income, we've gotten into a little bit of the income documentation that we are dealing with. Again, Fannie Mae full doc wage earners are about 60 to 65% of the loans that we're doing. We of course do this with bank statement loans, 1099 1 year, self-employed 1040s, and we can combine asset depletion or asset depletion just as a standalone. People are asking, well, if they have $8 million, why would they want to utilize the bridge loan? Some of these assets, guys, are locked up in amazing returns. We just had a loan come across our desk last month where there was $7 million worth of assets spending off a 17% return. They chose to use our money versus unlocking their assets to make their property transaction. Loan sizes, we had that question earlier. We have blown through very consistently the $2 million cap, so don't let that confuse you. We'll make exceptions to larger loans. 680 is the minimum FICO score. Property must be listed, so that's a caveat. If you don't plan on listing the property when we go to close, we need to know why. We also need a signed listing agreement with the real estate agent that's going to represent the property. More on that with your account executive. Reserve requirements, we're going to ask for 6 months, and then on larger loans, we'll ask for 12 months. And then again, Steve mentioned, we're an exception-based lender. So give us the ones that don't fit necessarily all of our program guidelines, and we still will use compensating factors to get them approved. Okay, so you guys are kind of piecing it all together, but you haven't really seen a loan in progress. So I'm going to walk through this, and then Rick and Steve, if you have anything you want to add, please jump in. So on the left side, you're going to see the bridge loan. So we started with a value of 1.35 million. This was an appraised value. We lent that borrower $1,012,500. So that was 75 LTV. Okay, so when we gave that loan, it paid off an existing loan that they had for $342,000, and they became payment free. You can see the closing costs there. They're substantial. You have 2 points for origination, making sure that you guys all understand that. And then also the appraisal, title, and 1 year of taxes and insurance were prepaid, built into that loan. All of that was taken care of with their equity. They transitioned that equity as a down payment, some of the equity, over to the purchase. Now you can see they bought a house that was a little larger. $1,550,000 was the purchase price. We wrote a loan for just over $1 million. They chose 65 LTV, and they put down $542,500. They chose that because of the interest rate that it came with that particular LTV. If you're not familiar with non-QM, the pricing on a loan is LTV bucket related. So it's going to be your FICO score based on your LTV, and that's going to be your corresponding interest rate. So the lower the loan to value, the lower your interest rate, and that's what they were focused in on. Their closing costs were $31,000, which was 2 points to the loan officer that originated the loan. Your standard appraisal, title, and escrow. So it was a normal transaction. But when they went to closing, we gave them their keys, and we also gave them a check for $42,560. They didn't pay a penny out of pocket for closing costs, and they still got that remainder. Why? Because their equity transitioned the entire transaction over to the purchase, and that was the remainder. They chose the 40-year IO, and so they had definitely zoned in on, if you go back to the bridge, there's going to be a $300,000 worth of remaining equity once that property sells. And they asked the loan officer if they could pay down the principal of the new loan with that money. The answer is yes, you can. And if you use your interest only feature, the payment would actually recast to that pay down as well. So they were looking for a $700,000 loan with a $700,000 payment that would reflect the $700,000 payment principal. I'm misquoting that. My bad.
But we say that's expensive on closing costs, but if you don't think that having 12 months to market that property and having that $42,000 to spruce it up before you go to sell it is going to result in a greater than 2% increase in your sales price, I don't know what to tell you.
Furthermore, I would add too, just to jump in, if looking at a private money option, which is where most of these borrowers are turning, the rates are going to be in the 12s, and 2 points is the low end of the market with that. You might be spending 3 or 4. So to Mark's point earlier on one of the previous slides, when you really look at some of the alternatives out there, the pricing on this, while initially there might be some sticker shock, it's still quite a bit lower than some of the number of the other alternatives that are available.
Okay. And then lastly, the addition of the seller concessions that are now in play in the marketplace, and having your real estate agent the flexibility to be able to negotiate that for both your purchase as well as the property you're selling. It's a huge advantage. Go ahead, Rose.
I've got a couple of questions here on points. So LendSure charges 2 points beside the broker charge. And also, do you charge 2 points on the purchase loan?
So we do not charge anything on the purchase loan except for our standard lender fee. Those points that are discussed in that 31,000 were the broker's origination. We do BPC and LPC comp plans, and we also have something that's kind of unusual to the industry called stacking, where we can actually take your origination and put it on top of the approved LTV. For example, this LTV was at 65, and you had a very focused rate-driven borrower. At 67 LTV, we would have financed the broker's compensation, and then in addition, we received the same interest rate that they would have qualified for at 65.
Phil wants to know, am I understanding correctly, the broker/originator only paid on the new loan?
I
didn't quite catch that. Steve, Rick, did you?
Yeah, I did. Yes, you're only able to earn commissions on your full commission on the purchase transaction. You do have the capacity to earn up to a 0.5 point on the bridge loan. But the reason that there's limitations on the bridge loan, with us charging 2 points, assuming the broker charges their half, plus the other lender fees, et cetera, we start running into high price mortgage loan limitations very, very quickly. So that's why those limits are in
because
place.
of the 12-month term. The 12-month term makes those,
Correct.
has a bigger impact. Those 2 points have a much bigger impact on a 12-month term than they would on a 30-year term for the same.
Yeah, that's a very, very good point, Steve.
Yeah, if you're interested in pricing out additional compensation on the bridge loan, just work with your account executive, because we do have the ability to do that when it does fit. Okay? Go ahead, Rose.
And Sean wants to know, will you lend on multi-family properties more than 4 units?
So more than 4 units, the answer is no. Our 5 to 8 unit program is kind of specific to the way that it's designed. To have that in conjunction with the bridge, we haven't had any success with that. Steve, am I correct?
That's right. We do 2 to 4 units by exception. We've done a couple of them. Our guidelines do not permit units on this product. We've done a couple of them, but the 5 to 8 unit product is separate from the bridge. We would not fund that in connection with a 5 to 8 unit.
Thanks, Steve. Okay, so for those do-it-yourselfers on the call, I just wanted to quickly note, if you go to our website, LendSure.com, we have 2 sources immediately for you. One of them is a boost calculator. This gives you guys the quick math. Hey, I got a borrower that that actually might fit this profile. That's okay. Log right in. You don't need credentials. You can pull up the boost calculator and it'll walk you through how to utilize the boost loan for that scenario. The next question is, well, what's the purchase loan pricing? Well, we have a Spark pricing calculator on there as well. So if you want to log in for the pricing on the purchase, you can. Again, the pricing for the departing property, the bridge section of Boost, is $899. So it's pretty simple. They're all priced at $899. So
Hey,
anyways, those
Mark,
are your pricing options. Go ahead, Rick.
Mark, just to interject too, if there's various LTVs or LTVs below 75, just to be clear, on the primary residences, the bridge loan is priced at $899 regardless of loan to value. So I just want to make sure that that's clear, because all the scenarios we've talked about are at 75. So it's at $899, but there are pricing benefits on the purchase transaction, lower loan to value. As Mark touched on earlier, we'll see much better pricing options than if we maximize the LTVs, which we can cap it out at go as high as 80% on the purchase transaction.
Our account executives, they're trained to actually work with you finding the best solution for your borrower. So these are a little bit complicated. They're not normal loans. So you gotta, if you want to lean on our expertise, that's what we're here to do, is help you not only get them to qualify DTI wise, but also examine the benefits of using their equity the right way. So go ahead, Rose, on the next slide.
So this is the resource kit that I put together for you guys. Just go to this URL, and don't worry, I will send you a copy of this slide deck and the link when in your thank you email in about an hour. But it has our non-QM resource kit, this thing. So what you do is you download it, and then there's individual images, not only on our bridge program, but on all of our different loan programs. You'll see flyers, email templates, slide decks that you can use with your referral sources. I've also included here some of our articles that we've written for Scotsman Guide, infographics that you can use, and this handy dandy white paper. It's an extensive white paper on mastering non-QM. So please look at that. Look for that in about an hour. So questions. I've gotten lots of questions here on the credit scores. What's the minimum credit score requirements? And I assume they're talking about the bridge loan and the new purchase one.
Go ahead, Steve.
680 is what the guidelines indicate. Again, we've made some exceptions to that, but that is the cutoff.
Okay. Can gifts be used for the reserves?
No, I don't. We don't allow gifts for reserves, but you could use gifts for something else other than reserves and use the bridge proceeds for the reserves.
All right. Are non-owner occupied allowed on the purchase?
Rose, can I just add one element? I did get a call from one of my account executives about a month ago. And the reason I'm bringing this up is that people just assume that this is such equity driven that people that don't have a large amount of equity actually don't need the boost program. And I would tell you that The scenario that I received, the person didn't have a lot of equity that was available at 75 LTV, but they needed to get rid of the mortgage payment in their DTI. And so this program actually helped them qualify, and they took the program all day long. So I'm letting you know this was their only option, just by DTI advantages. So I wanted to make sure.
I've seen it where the bridge proceeds are only $25,000. You know, not a major part of the down payment, but to get rid of the debt, as you suggested, is part of the motivating factor there.
Hey, Rose, one other thing to add to that too, before we answer the question that you asked about non-owners. This program works for all the different types of borrowers that we work with. So while we've talked fairly extensively about conforming borrowers, this also works really, really well for your traditional non-QM borrower that needs to utilize bank statements or asset depletion or a combination of a multitude of different income revenue streams to be able to qualify for a purchase transaction. And then they would look to stay in the loan long-term versus maybe paying it off after month 7 and that EPO period expires. So that's really, really important to note that this is not just limited to conforming borrowers. We're happy to look at all different types of borrowers as long as they meet that credit requirement.
And then on the non-owner occupied question, is that what it was, Rose? Do we do non-owner occupied?
Yeah, our non-owner.
Yes. Go ahead.
Yeah. Oh, I'm sorry. It's specifically, Roger says, are non-occupied co-borrowers allowed on the purchase?
It's possible, certainly. We do allow that. So, I mean, it has to make sense when you have a non-occupied co-borrower, but it's not out of the question.
Okay, and then Andre's asking, can we get a matrix and underwriting guidelines for this? Absolutely, Andre. Do me a favor, when you get that thank you email, just reply to that. That'll go to me directly, and I'll send that off to you. And I'll also introduce you to your account executive if you don't have one, if you haven't spoken to them yet, and they can walk you through it and answer any loan scenario questions. How long does it take to complete a transaction?
Question. You want me to tackle that? So the pre-approval process in the beginning is 24 to 48 hours. And then ultimately you're gonna move from that to hopefully get the borrower shopping with the real estate agent and getting into an escrow. From there, it turns into kind of a normal loan where we're gonna be doing 2 loans, but ultimately your normal turnaround process on a 30-day escrow is just fine. And then ultimately you wanna know this, as soon as you go to a CD stage, because the departing property is treated as a cash out refinance, you need your rescission days, your CD days. It all calculates out to basically 10 days from the day that you initially put out your first CD. You need 10 days to complete the transaction. And that's hoping that they're with this, both loans are with the same escrow.
And I've got a couple of related questions from different people on state to state. A, can you go from selling in one state to buying in a different state? And in relation to Texas, this could work if you're moving from a different state and purchasing in Texas. Is that correct?
I'll field that one. We absolutely can. And we promote this program to our Texas customers utilizing exactly what you talked about. There's no denying the fact, being a resident of Southern California, there's a mass exodus or migration, if you will, of people leaving California and moving out to Texas, leveraging all that equity out here in California and being able to purchase a much nicer home in Texas. And we've been able to utilize this program on both ends of the transaction to be able to help people out. So we absolutely are able to do that.
Angelica wants to know what's the LTV on the new purchase?
So on the new purchase, we can go as high as 80% loan to value. Again, I think Mark and Steve touched on earlier that our best pricing options are going to be maximizing the cash out of the bridge loan to pay down and start at LTVs in the 65 to 70% range. The pricing gets really, really attractive in those areas, but we can go as high as 80 on the purchase if need be.
Okay, Philip wants to know, we're licensed in Florida and the borrower was moving from Florida to another state that we are not licensed in. Will we be able to close?
That's kind of a case by case.
Yeah.
Depending on what
you have to be licensed to do an owner occupied purchase in a state. I don't know the specifics of that though.
Okay, can you do non-warrantable condos under this program?
Yes.
Both ends.
Okay, and I'm not sure if I understand the question, but Pamela wants to know non-contingent in 48 hours. How do you value the properties?
So we'll start by pulling up information online. There's a number of different websites that are available. By no means are we using that as gospel, obviously. We'll get appraisals on both transactions. So there's a full appraisal required on the bridge loan and a full appraisal required on the purchase. But at least as a starting jumping off point, we'll do TBD purchase of a target purchase price that they're looking for, and then pull the information online for the bridge loan to be able to get a rough estimate as to what equity would be available.
Okay, and Char is asking, can we invite our realtors to your scheduled webinars next week? Char, go ahead and email me, respond to that email that you're going to get about an hour after the webinar, and I'll walk you through it. We'll figure it out for you. And then what's the max DTI on the new home purchased?
50%.
Okay. Can the departing residence be in a manufactured home on land, not in a park?
No.
Okay. Let's see, sorry. Do we have temporary buy downs on the new purchase?
Yes, we can absolutely do buy downs. Mark touched earlier too on our ability to be able to stack origination points. We can also do that partially or in full, depending upon loan to value of buy down points. So I know
we
I've done
do buy downs. We don't do temporary buy downs. We do rate buy downs.
Right.
Okay. John wants to know, is there a chance to do a bridge loan on a VA loan?
No. So
You
again,
can do
we
a
would
bridge
need to
loan
do
on a property that was financed VA, but we wouldn't do if we're doing the bridge, we're doing the purchase. So we wouldn't do a bridge loan in connection with a VA purchase program. We don't do VA loans. So we have to do both of the loans. But you could, if you have VA financing on your current primary, we could certainly do a bridge on that and pay it off.
Okay. Andrew wants to, circling back to the loan scenario that we did, so the total closing cost for both loans in this scenario was $85,000.
Is that what it added up to? You had 2 points on $1 million purchase, so I mean on $1 million bridge, so that's 20,000 of it, and then the rest of it is, Go ahead.
Yeah, you got the impound, so it's 1 year of taxes and insurance that's impounded into that loan.
Okay. Can the new purchase be an investor property?
Yes.
Yes.
Okay, great.
Yes, the new purchase can be. The bridge would be at a lower LTV, assuming that's a non-owner bridge to a non-owner bridge to non-owner purchase.
Lynn wants to know, do you have co-branded social marketing materials? Not co-branded, private label, so that our name and logo won't be on it at all. You can just use your, take our banners and go ahead and use them on your account. So our name doesn't have to be on there. Unless you want to, unless you want to do a co-branded presentation to your referral sources, in which case an account executive will be happy to present with you. But the materials that we're going to be offering you don't have our name anywhere on there. That is all for you. Sorry, I've got so many questions. For an elderly borrower who has no mortgage on their current condo and doesn't want a loan on her new condo in a different town, is there an EPO timeframe or minimum loan that would be declined? She intends to pay it off once the new old home sells.
That would be based on the contract that your brokerage has with LendSure. So just talk to your broker or just review the contract.
Okay, and that one is related to the EPO as well. Lots of questions on EPO. Do you require title insurance on the departing property in addition to the appraisal?
Yes.
Is there a minimum loan amount on the new property?
$250.
And I think we already answered that no, the two properties do not have to be in the same state. Do I understand correctly that you cannot use this program for a borrower moving from a property in Texas that they'll sell after to use a property in a new home in Texas?
Correct. So Texas Homestead Act gets in, it interferes with the cash out owner occupied portion of the bridge. So yes, that wouldn't work.
Is there a calculator that we can use that we can get a feel for potential LTVs? Yeah, there's two calculators on LendSure.com. There's the bridge loan calculator that you can put in, and you can put in the home value, and you can play around with like what's the loan amount, and that will show you how much cash you get out. But there's, if you're looking for specific pricing for LTVs and stuff for the new purchase, then you can go to Spark, our pricing engine. That's on our website as well. So those are the two resources. But you can also just call up your LendSure account executive. They're very open to like working with you on different scenarios and can guide you through that program. The departing property is owned outright. New purchase will be within the 75 LTV that has been obtained on Boost Loan. Is this scenario you will still offer since there will be no long-term loan?
I didn't quite catch that one, guys. Did you?
Yeah, I think what they're asking is if they have enough equity available in the departing residence, do we need to get a loan on the new property? They want to purchase it all cash. So we would have a minimum loan requirement on the new purchase. We do not have the capacity of doing a standalone bridge loan without the purchase transaction on the other side. So
we make our money on the purchase loan. So we don't want just the bridge loan. The bridge loan is really a facilitator more than anything else. It's not much of a profit driver for us. So we're really looking to get that purchase loan by offering this bridge.
Yeah, that's a good way to put it, as a facilitator. What I've had most people do in that scenario is they take out a loan, best case scenario price loan on the purchase transaction. Then when they sell the property that has the bridge loan on it, they wait that 7 months to ensure they've made the 6 full monthly payments. And if at that point they want to pay off the balance of the loan at that time because they've sold their home successfully and they're sitting on all that equity and they want no mortgage payment, then they have the ability to go ahead and do that.
So my final messaging on that would be, when you say no payment for a year, it is amazing what kind of crawls out of the woodwork to start playing around with that statement. I think we've heard it all, but the reality is that the intent of this program is to help people facilitate a purchase transaction, utilize the equity that's locked into their house, buy before they sell. If we keep the guardrails on that conversation, it becomes a phenomenal program. We're very excited with it, and we're doing a lot of them. If it falls out of that, usually you're going to find something else that would be more advantageous for your borrower to use than the Boost program.
I'm not sure I understand the question, but I have a couple of different people asking about TBD scenarios. Can we submit a TBD scenario, and can we send in TBDs before they find a property for underwriting?
Honestly, sorry, Rick, that's the best. That's really the design of the program, is to get your borrower through the pre-approval process. That's credit driven. An account executive doesn't do that. It's actually underwriters within our system that do that for the account executives. They issue out that pre-approval. You can work with your agent. You can move into the non-contingent status, get the borrower shopping, and start the cycle. That's how it's intended. Now, I'm going to say that that's the way we like to do business, but we get the fire drills every day. Hey, our property has been for sale since December. They're coming up on their escrow demands. It's about to unravel. Can you help me? And the reality is, yes, we can jump in and get involved with those fire drills very quickly for you and keep that escrow on track. Okay.
Mike it's more of a comment, but Mike says, I can see this program being an option for new builds when the builder won't take a contingency and the property won't be complete for 6 or 7 months.
Take it away, Rick.
Yeah, as a matter of fact, I just got a call on that exact scenario yesterday, and I'm helping the borrower out with that, where they're able to do the bridge loan up front, be able to meet the closing requirements of the new builder. It's not quite 6 months, it's 2 months out for when the completion of the new construction will be done, but we're able to get that done as well. So there's tremendous flexibility in the program. Steve touched on a loan earlier that was very complicated and dynamic in the way that we put it together, but we were able to do that as well, utilizing some of the proceeds out of the bridge loan to be compounded with assets that the borrower currently had to meet an asset depletion requirement and be able to help the borrower qualify for a new purchase that they otherwise weren't going to come close to. The debt to income ratio without that was like 90%. So there's so many different variables that we can do. And you really need to reach out to your local account executive that has all the knowledge and the training of being able to help you structure these loans, because they're super unique and different.
I've got a couple of different people asking me if this is available for ITIN borrowers.
No.
Okay. Is there a prepay on the purchase?
On a primary, no. On a non-owner occupied, yes.
Okay. And sorry. So Gary says if IO on purchase side and departing home is sold and funds used from the bridge to pay down the purchase loan, but not pay it off completely, how much can the purchase loan be paid down without triggering EPO?
That's a good question.
100%?
I don't really have an answer. Steve, are you confident in that?
I'm not confident. I think it's 20%. So I'm not positive of that, but I think it's in the note. I don't have the details. I believe it's 20%. We can check that for you.
Just to kind of answer it from an historical point of view, we've dealt with some very large principal buy downs, and our servicer accepted them. There was no recapture and there's no EPO triggered. So it's part of the program. We get that. But just to let you know, our EPO is in every broker contract we have with anybody that's on the call today. Investigate that. And if it's not for long-term financing, and this is used more as a short-term financing for your borrower, your intent is to refinance them, that's okay. Just know the rules of engagement that you're playing with.
Okay. Holly wants to know if the bridge loan is paid off from sale prior to the 12-month mark, is there a refund of the 12-month PITI reserve?
Yeah, it's per diem and you only pay what you use. So if they're only in it for 93 days, they're 93 days worth of interest, and any of the taxes and insurance that have been prepaid as well get refunded. So it's all of that's built into the model.
Do you require escrows on the new home purchase?
Rick, you want to tackle that one?
I'm sorry, I was responding. I'm getting emails too from clients that are emailing me as well.
It's funny.
About
so
this.
the answer is yes. We normally impound every loan, but we do have the ability, as long as it is not an HPML customer, you do have the ability to remove impounds for a cost.
Yep, there's a hit for it. There's a FICO requirement and an LTD requirement for waiving impounds. We generally require them. It can be bought out if you meet the criteria.
Philip says, I see that LendSure is making big money up front. I don't see where the broker can add origination and be competitive with declining rates. The risk of an EPO would be high in a rate declining market, and a little reward for the broker. What are your thoughts on this?
Well, it's no longer a rate declining market. I just had our swaps go up 47 basis points. I know that's hopefully temporary. There is no protection. You're going to get your borrower involved with this program because of the end goal. There's complexity to this that needs to be brought out. Everybody needs to understand the reason to use this tool and the financial situation that it presents. We can't protect you from an EPO, just like the borrower telling you that they're going to make 6 or 7 or 8 monthly payments based on your contract with us is no different than with LendSure or any other investor you're brokering loans to. So that's going to be your choice. We don't have any protection for that. It is what it is. We do have very limited amounts of EPO activity. As a lender, I can speak to that from that point of view. Other than that, we don't really have any protection.
I would add to that and say that most borrowers that are out there simply don't have the resources available to be able to make the purchase, and therefore they're limited to making a contingent offer. And the only way that they can make a non-contingent offer is by accessing the bridge loan. So just speaking from experience, someone that's out there every day on the front line promoting the program, I get very little to any pushback whatsoever with concern for the EPO. Really, it's kind of a non-event. I make sure that the originator knows that the EPO exists so they can set that expectation with the client, but have not had the client push back whatsoever.
I'm not quite clear on what he meant by the "we make big money on the front end" part. I'm not sure. On the purchase transaction, we're charging our lender fees. That's all we're charging. You charge your origination fee on the purchase transaction. We get the 2 points on the bridge loan. We may end up holding that for a year to earn it, right? But the reality is that's not a lot of money. And what we're really trying to do is help you close more purchases because you couldn't do it without the bridge loan, or waiting 6-8 months for that guy to sell his house. So there really is a benefit to you. And it's a benefit to the borrower as well. He's probably going to get more for the property if he has more time to sell it than he would otherwise. So I'm not quite clear on that part of the question or comment, I guess.
Okay. I'm getting several questions on like when is our next webinar? How often are we presenting this webinar? How do I, can you give me a heads up on our webinar calendar for the year? I don't have a calendar that I do for webinars set in stone because we want to make sure to kind of offer the most timely information. So if there's big interest on like investment property loans or something like that, then we will do a webinar that month. But the best way to kind of keep abreast of all of our webinars, follow us on social media, follow us on LinkedIn, because what I'll do is as soon as I schedule a webinar, I'm going to put a post up there that says, hey, here's the date and time for the webinar. Here is the link to sign up. So that really is the best way. And also program information, new programs, program changes, all sorts of great stuff on our social media, including little scenario videos, all sorts of really useful stuff. So I suggest you go to LinkedIn, find LendSure's page, and just click follow on that.
And I'll just add one more item to that, Rose, is you should really take advantage of our account executives. They're here to help you. We understand that this is kind of new subject matter, and you're not going to be the subject matter expert. So have them support you. If you invite your real estate agents you work with to a webinar and have one of our account executives co-present with you, I can pretty much guarantee that you're going to receive some positive feedback and possibly some loans. So I encourage you guys, if you're interested in learning more, go to that next step, reach out to your account executive.
Okay, and then Carrie, I see you have a very specific loan kind of scenario that looks a little bit complicated. So I'm gonna have an account executive reach out to you and answer it. I don't want to give you incomplete information on that.
Come on,
one.
Rose, we can have Steve underwrite it right now. What's the matter?
Do you have a payment on the bridge loan?
No,
it's payment free.
All right. What's the limit on seller concessions for the new product? For the new purchase, rather.
6%, I believe it's generally, if it's an owner occupied, it's 6%. It's 6% or the amount of the non-recurring closing costs, I believe is what our guidelines would indicate.
Yep.
Okay. Let's see. Carla says, can you use the bridge if the departing residence is FHA, VA, USDA loan? So in other words, so that would just mean paying off those loans, right?
Right. We're taking out the current financing on the bridge property. Whatever that financing is, whether it be VA, FHA, USDA, I don't care. We're paying it off. So it's going to not exist anymore. And then we're going to do the purchase with one of our loans, not an FHA, VA, or USDA loan.
All right, and I'm going to do a couple more questions, and then I'm going to address the rest of them offline. The next webinar, we already talked about that, sorry. What's the, can we go into minimum and maximum loan amounts one more time? We've got on both departure properties and the new properties.
So the minimum's $250. Go ahead.
On the bridge, it's $250 and $2 million as a max. $250 minimum, $2 million on the max. We've done exceptions on both ends of that spectrum. On the purchase, I believe our maximum loan amount is $3 million. So that's as much guidance, I guess, as I can give you. What's our minimum loan amount on a purchase? $150, I think.
Yeah, 150 on the purchase.
So it could feasibly be $250 and $2 million on the bridge, and $150 and $3 million on the purchase. Those are the broad ranges.
Okay.
And before we leave that, Rose, I just want to give one example. We just got this approved in December. It was a departing owner occupied for 2.3. It was a departing non-owner occupied in investment for 2.1. And it was a purchase in a Temecula, just a gorgeous estate. And I believe that purchase was 4.5 million. And then they put almost 2 million down. We combined all of those together. It was over $6 million to one borrower that we approved in a bridge loan scenario. So it was 2 departings and 1 purchase, and we had all of that approved. So I'm just giving you perspective. Don't let loan amounts on the high side alleviate you from trying to see if Boost can be, an approvable situation. We're making those types of loan amount exceptions pretty consistently.
Okay. Would borrower need the listing agreement on the departing residence before submission to underwriting, or just PTC?
Yeah, prior to
Prior
close.
to docs in general.
Yeah.
I mean, we do grant some latitude. Mark touched on this briefly. We require there to be a listing agreement before we go to docs. We want to make sure that the property is being sold, right? But look, if the borrower says, I need 2 weeks, I need 3 weeks to clean up this property before we can have any showings, or before we want to list it publicly, we can have that latitude up to the maximum of 30 days. So if there's some reason, or maybe like I just did one the other day where the seller, the seller on the purchase end of the bridge loan did a 29-day lease back. So my people couldn't leave the property that they're living in, so that they were going to be sitting there for 29 days, didn't want to do showings while they were living in the property. They wanted to get out and paint it and all that. So, this facilitated that. We do have some latitude, but we do want the listing agreement up front, docs, prior to docs.
Okay. And can you help us word a script to an agent using the products? Take a look at the kit that I send you in about an hour, the private label research kit, because everything there is written for a borrower or a realtor. So you might be able to just grab a copy right from like the emails and the flyers, and then just use that as talking points. So I think that might be helpful to you.
Whoever that is, as a loan officer, reach out to me directly, please. I'd be happy to work with you on that.
Great. Andrew, yeah, you can go ahead and contact Mark. I'll make sure to include his contact info when it's in the slide. It's in slide 2, his email address. The scenario shows a 40-year term. Is there any other terms available?
Yeah, all of our loans are traditionally a 30-year fixed. We do have, I believe, 2, if not 3 options of interest only. This is our 10-year interest only option, where it's actually a 40-year loan. The first 10 years are interest only. It converts into a 30-year fixed with the exact same interest rate. So there's a price adder for that. So this is intended for people that A, want to have a payment recast, and then B, are looking for longer term financing than being refinanced 6 months or 8 months out.
All right. Okay, with that, I want to just say thank you to everybody for joining us today on our webinar. Sorry about that, folks. Just 1 second. And if you haven't, please take a look, keep an eye out for our for an email from me that's going to have the recording of the webinar, that's going to have the link to the slide deck to the webinar, and it's going to have a link to our non-QM resource kit, which includes all those private label marketing materials, infographics, and that. Speakers, any parting words? Mark?
I just have 2 points. I've never been on a presentation where the Q&A lasted longer than the presentation, so that was amazing. It just also shows the level of interest in the product, so I love it. And then secondly, if your borrower needs a boost, give us a call.
Okay, great.
Absolutely.
Rick, any parting words?
I think Mark touched on it. We're just excited to be able to help people out. It's the program has had unbelievable interest. So just reach out to your local account executive. We're happy to be able to field any questions that you might have, review scenarios, try and help you resurrect loans that might be in your pipeline. So we're ready to help you hopefully close more loans.
Awesome. Steve, any parting words?
We appreciate you joining us. Like Mark and Rick said, this this product has really taken off. It's really helping getting interest from realtors. This is a purchase money market, and this is a valuable tool, and we've seen it taken off like crazy. So there's a lot of people doing it. The borrowers are liking it, the brokers, the realtors are liking this product. So we're glad to be able to share the information with you and hope you can put it to use for your own production.
All right. Thank you so much, everybody. Have a great day.
All right. Cheers.
Thank you.
Bye.